Hello and welcome to this weekly market recap for the week ending Friday, October 10th, 2025. I'm Tom Bowley, Chief Market Strategist at Earningsbeats.com. It's a pleasure to be with you all again this week. Well, we finally saw some selling. Been talking about a lot of different issues over the past few months and just seemed like the market, no matter what, just kept wanting to go higher and higher and higher. It was a very, very slow crawl to the upside, but quickly on Friday, we saw a bunch of selling kick in. So we got some really interesting charts to show you this week. And we're going to get to those in just a minute. Keep in mind, from a seasonal perspective, we have the best time of the year coming up, starting at the close on October 27th. So we do have a window here over the next couple of weeks where maybe we get a little bit of selling to bring things back down to earth a little bit. But I still think toward the end of the year, into year end, we're going to see more strength ahead. So I do think this is more of a short term kind of a pause in the market rather than a long term. But again, we'll talk about that in just a minute. But let's go ahead and take a look at what happened over the course of the past week by starting off with the major indices. You can see the Nasdaq 100 led the action last week, dropping 2.27%. S&P 500 down just a little bit more, minus 2.43%. Then the Dow Jones, which lost over 1,000 points, or about 2.75%. Russell 2000 losing over 3.25%. The mid-cap S&P 400 mid-cap index dropping nearly 4%. And transports, another rough week for the transportation group, dropping almost 5%. So really a rough week. However, it mostly was due to just Friday. So if we switch this and just take a look at the intraday, you can see how much of the selling took place just on Friday. Dow Jones dropping over 800 points, almost 900 points just on Friday alone. And you can see the Nasdaq 100 dropping 3.49% just on Friday. So if we go back and we pull up that weekly chart again, you'll see the Nasdaq 100 was only down 2.25 for a week, for the entire week, but was down much more than that, well over 3% just on Friday alone. So the overall market was not doing badly until we hit Friday. And then we saw a lot of selling. There was a little bit of a hiccup in the market on Friday because President Trump upset at China, talked about increasing tariffs significantly. And as soon as that talk started, the selling began and never really ended. We saw selling throughout the day on Friday, and we saw some additional selling in after hours on Friday. So that may set up for a rough Monday morning as well. We'll have to wait and see how the action takes place over the weekend, see what we wake up to on Monday morning. But certainly the way we ended was not the way the bulls would like to see it. But on the other hand, I feel like the market really needed some unwinding after going up day after day, week after week, month after month, really almost relentlessly since that April low. Moving on to the individual sectors, you can see that for the last week, utilities and consumer staples, these are two defensive groups, the only two groups to actually finish in positive territory. Everything else was down. Healthcare down almost 2%. Everything else was down more than 2%. Technology held up pretty well, only dropping 0.22% for the week. But again, if we just zero in on what happened on Friday, technology dropped over 4% just on Friday. So if we go back, take a look at that 1 week performance where technology was down just 2.2%. Just by doing some simple math, you'd realize technology was actually up almost 2% going into Friday. So it was a really strong week for growth. It was a strong week for technology. And then, of course, once that selling kicked in on Friday, we saw a lot of the growth areas of the market sell off, including technology. And a lot of that's reflected in the negative numbers that you're seeing here for the week. So energy down more than 4% for the week. Consumer discretionary, 3.8%. Communication services, down 3.08% for the week. Financials and industrials, taking a big hit, even though they did a little bit better on a relative basis on Friday for the week. Those groups had lagged earlier in the week and still ended up lagging for the entire week. So all in all, not a good week. But again, most of it was because of a big sell-off on Friday. We're going to take a look at those charts. In fact, let's go ahead and start with the S&P 500. So on the S&P 500, you can see this big drop on the daily chart. Not only did we break below the 20-day moving average, but we fell all the way down almost to the 50-day moving average. So from that was 182 points, 182 points on the S&P 500 lost just on Friday, taking us down to 65.52. If we pull this up from a weekly perspective, you will see that we dropped 163 points. So again, we were up prior to Friday and then gave it all back and then some. But clearly with that Friday action, things look a lot worse going into the weekend than they would have had we not seen all that selling. That goes without saying. Anyhow, looking at the weekly chart, the daily chart looks like we're breaking down and it looked really bad. But on the weekly chart, we have been trending so far above the 20-week EMA. We had a lot of room potentially down to that 20-week EMA, and we still do. The 20-week EMA comes in at 63.61, and we finished at 65.52. So we could see another day like we saw on Friday, which would take us back to about that 20-week EMA. And I think that's where the real battle, in my opinion, would take place. Nasdaq 100, again, big breakdown below the 20-day moving average. And if you look back, I mean, just looking at the selling and the size of the distribution from open to close, I think you can pretty easily summarize that this is the worst day that the market has seen since back in April when we were putting in those lows, early April. So really rough day for stocks. I think that, again, could lead to some weakness at the beginning of next week. We'll have to see where we stabilize and when buyers come back in. I think we need to be very, very careful going into next week. Small caps, IWM, same thing, breaking down below the 20-day. Still got a ways to go to get down to the 50-day. And if we go out to that weekly chart, you can see the 20-week EMA doesn't come in until we get all the way down to 228. Now, I don't know if we're going down there or not, but after losing as many points as we did this past week, 8 on the IWM, it would only take about another 8 or 9 to get us down to that 20-week moving average. And it wouldn't be a horrible thing for the market, to be quite honest. I mean, if you look back in July, the last time the IWM had a really big sell-off, in 1 week, we went from being very stretched all the way back to the 20-week EMA. So another week, or at least starting off next week with some selling, wouldn't be surprising the way we finished today. And it would unwind some overbought conditions. You can see the weekly RSI on the IWM was hovering up around the 70 level, which we hadn't gone above 70 all the way since back in the early part of 2021. So we were about as overbought on the weekly chart on the IWM as we had been in for probably 4.5 years. And so the selling is starting to get some relief there. That 14 period RSI, of course, this is the weekly chart. So that weekly RSI dropping to 61. We see a little bit of selling next week. Maybe we get this all the way back down to 50 or into the low 50s. I think that would be a good thing for the market. Semiconductors, this is always a big area in the market. You can see we really had not seen much selling until this week, and especially Friday. This is a daily chart. So you can see all of the selling took place on Friday. We were over 28,000. On Thursday, we had closed over 28,000 for the first time in history. Came down, not only failed to hold 28,000, we failed to hold 27,000 and the 20-day moving average. So again, this is another index that looks like it's set up for some additional weakness come Monday. All right, I wanted to take a little look or take some time to look at the Mag 7 stocks, just give you a little idea of maybe where we're heading on these stocks. Apple, broke down below the 20-day moving average. The last breakout occurred at around 240. So it seems like we still got at least a couple of percent to the downside on Apple to get down to that key support level. Microsoft, it looked to me like we were putting in a cup on Microsoft. I really was a big fan of Microsoft earlier in the week, but all that strength gave way. We lost both moving averages on Friday. Now it looks like the stock is setting up to go back and possibly retest those recent lows, which could be down in the mid 490s. Again, we're talking about another 2, maybe 3% to the downside on Microsoft. NVIDIA, after getting up over 195, setting an all-time high, big reversal on Friday, coming back down, closing at the 20-day. This is kind of an area where we broke out from. So NVIDIA is going to be an interesting one on Monday. If it continues to sell off and can't hold support, I think that's something that could maybe escalate into a lot more selling in the semiconductor area. So that'll be something we keep an eye on Monday for sure. Meta was showing some strength, but we got up to that 20-day moving average. Also, we got up to a key area of price resistance, and we essentially failed at both, going back down and closing at the lowest level we've seen on Meta in about 2.5 months. So not very good action there. Certainly looks like we got more selling potentially on Meta. And what I'd look for here is maybe the lows that we saw around 690. We've had 3 of them. That would be another 2% lower on Meta. If that doesn't hold, then you've got some other support just around that 680 level. Google just looks like it, was way stretched. I think we're probably looking at maybe the top of gap support, which comes in right at about the 50-day moving average. That would be $10 or roughly about 4% on Google. I certainly think that's a real possibility going into next week. Amazon, another one that I thought was really starting to strengthen earlier in the week, and we were strong all the way up to Thursday, went through the moving averages, but all of this tariff news and the big selling in the market came at a bad time for Amazon, because all of a sudden that downtrend line looks like it has now resumed again. And you got to look at these recent lows. First one being at about the 211, 212 area. Again, that comes in at about 2% below where we are currently. Then we've got Tesla, which broke below its 20-day moving average. I now think it could go back down and fill this gap around 396. That would be $17 or roughly 4%. Couple of bonus stocks in addition to the Mag 7. We got Netflix. Netflix looks like it reversed. I was really believing that we were starting a pre-market run or pre-earnings run to the upside on Netflix. I think this may have cooled that based on that big reversal on Friday. But I would say if we do pull back, I think somewhere in the 1180 to maybe 1200 area, somewhere in there is where I would be looking for support. Again, that looks to be about a 2 to 4% drop potentially. Broadcom breaking down below recent lows. It looks like maybe another test of gap support, which would, or not another test, but a first test of the bottom of gap support, which comes in at about 307. That would be probably about 5 or 6 percentage points below where we finished Friday. And then Advanced Micro, one of the strongest stocks in the market. We've got some gap support right around 204. That would be about 4 or 5% from where we finished Friday. That's where I'd be looking for some support on AMD. All right. For those of you that are new to earningsbeats.com, first, make sure you like the video and subscribe to the channel. That certainly will help us with the YouTube algorithms. So even if you can't join us for whatever reason with our service, definitely help us on YouTube. We'd certainly appreciate that. We do try to give out a lot of really good information for free, and so we could certainly use that support here on YouTube. If you do want to try us out our paid service, we have a 30-day no-cost trial. Right now, I think this is, with everything that took place on Friday, this would probably be a good time to have maybe a little coaching. We can kind of show you what we're all about. I think this is when we shine. As the market gets worse, this is when I think we kind of rise and kind of become the cream of the crop. I think our track record is second to none in terms of market guidance. And on Thursday, in our daily market report, I wrote to our members and I said that we were looking at a sentiment indicator that suggested that we were about to reverse, or at least that the risks of a reversal were growing. I told everyone, to do what you needed to do to kind of lessen the risk, lessen exposure. I said, for me personally, it meant raising a lot more cash, which is what I did. Thankfully, that worked out with the big reversal on Friday and the movement to the downside. But if you want to experience our guidance, let us help you get through this period, whatever it happens to be. Make sure you go over to Earningsbeats and sign up for that 30-day free trial. You do have to give credit card, but we will remind you at the end of the 30 days before you get charged that you're going to be charged. And not only that, we'll give you a great special at that time. So check us out. This is a great time to check us out, with the big reversal that took place on Friday. Scrolling down on our website, you'll see that there is an area where you can sign up for our free newsletter. This is completely free, no credit card required. Literally, we've had tens of thousands of folks join us on our EB Digest. Name and email address is all it takes. Make sure you subscribe. I am going to provide on Monday the chart that I included on Thursday that pointed out the reversal that, you never know it's going to take place. I don't want to say that we guaranteed anything. We certainly didn't. But what we did say was that the risks had increased significantly in the market and that folks needed to be really careful going into Friday. And you saw what happened on Friday. If you want to see the chart that we sent to members explaining why we were getting more and more cautious and more nervous, sign up for this newsletter and we'll show you on Monday morning in the EB Digest. All right, just a few more things before we get going. I did want to pull up this 5-day moving average of the equity only put call ratio. That's down here in the bottom panel. Whenever you get this 5-day moving average down here at these extreme lows, and this is a 3-year chart. So when you get all these lows down here where I put in the vertical red dotted lines, these are all levels where there's a lot of complacency in the market. In other words, retail traders are getting extremely bullish. Like the masses are all getting together and getting extremely bullish. Now, in July of 2023, we saw this reading, the 5-day reading, go below 0.5, indicating that there were a lot more calls being traded versus puts. That's when you want to be careful, at least be thinking about it. And you can see we didn't exactly come to a perfect top, but market really didn't go up much after that. And then we ended up going into a correction over the summer. The next time we had this reading go below 0.5 was back in January of 2025. It coincided with a significant top. Then we did it again at the end of May, and we coincided with a significant top, at least for a short term. Again, this is a short-term indicator, a short-term signal. This is not telling us that we have a bear market coming. It's not telling us that we even have a correction coming. I mean, we did have a correction there. We did have a bear market here, but you notice on this one, we didn't. This is not a long-term predictor. It's a short-term. So it's just telling us that short-term risks are elevated. We first hit this 0.5 or lower reading back toward the end of September. We went slightly higher in the market, and you can see we dipped back down below that 0.5 again. And now we're starting to see some selling as a result of that. When everybody in the market starts to get bullish and retail traders are buying calls hand over fist, you've got to be prepared for market makers to reverse that action. And that's exactly what we saw here. So this was one sentiment indicator, not the one that we sent out to our members on Thursday, a completely different indicator, which corroborated this signal. And as you start getting more and more signals, that's when those risks start to really grow to continue treating the market, as we have for the past 6 months. We needed to take some precaution, and Friday told us exactly why we needed to be taking precaution. All right. I wanted to show you this S&P 500 chart here coming off that April low. And these are my sustainability ratios. Now, prior to Friday, you're going to see that the majority of these ratios were still doing really well. So what this tells me is that Wall Street is not getting out. Now, they got out some today. Everybody was getting out, Friday. But normally for a bear market, you're going to see a much more lengthy period of rotation from aggressive stocks to defensive stocks, aggressive areas of the market to defensive, or growth oriented versus, to value oriented. We didn't see any of that heading up to this. So I believe this is going to be very short term in nature. Doesn't mean it won't be painful. If you're a trader and you stay 100% long, it could get very painful in a hurry, but I don't believe this is going to be something that's going to last for very long. We're going to evaluate it as it goes. I think being in more cash at this point makes a lot of sense. That's what I talked about on Thursday. And we'll see, how the market responds. But, looking at these sustainability ratios, you can kind of see all of these were setting new highs in October, or just about setting new highs. There's the Russell 1000 growth versus the Russell 1000 value. So that's a growth versus value type ratio. Money was still going into growth all the way up through Thursday. So it's not like Wall Street was prepping for something. So again, I don't think we're going to see a lengthy decline, but it might be significant short term. We'll see. Another large cap growth versus large cap value ratio right there. You can see a new high there. Mid cap growth versus mid cap value going up, and small cap growth versus small cap value was very strong in October. Although we didn't set a new high, we'd been rallying pretty strongly for the last couple of weeks. So you can see the money has been rotating into growth, and that's not normally what we see right before a lengthy, bear market. So I don't see anything significant coming in terms of duration, but we could see some more selling at the beginning of next week. In fact, that's what I would be expecting based on the way we finished on Friday. All right. Last thing I want to do is just show you that the volatility index, we spiked up, we finished above 20. One of the things I always say is that, when the VIX is rising and moves through 20, not a whole lot good happens for the stock market until that volatility index tops. We don't know where it's going to top. Sometimes, during secular bear market advances, we might see it top around 20, 22, 23. Sometimes we might see it top around, 27, 27 and a half. We might see it head into the 30s. I doubt that we would see anything worse than maybe the mid 30s. And I don't think we're going to see it I don't think it will go up that high, but I do think it's going to go higher than where we went on Friday. And so we've got to be careful, because anytime that VIX is above 20 and rising, that's when the losses can occur very, very quickly. And, being in the market, fully invested and watching, you saw the Nasdaq drop. Well, technology dropped over 4% on Friday alone. Who's to say what's going to happen on Monday? We might see a big gap down Monday morning, something that we'll be watching and seeing how the market reacts, where the money rotates to after something like that occurs. Or maybe there's just more intraday selling, but we need to watch that closely to get a better sense of how long this might last and how deep it might go. So I'll be back talking to members all next week in our daily market report, keeping you posted on what I'm seeing and where I think the market could be headed. So make sure you check that out. And for those of you who are not Earningsbeats members, again, go back over to our website, earningsbeats.com. Right here, you can start your free, no cost 30-day trial. So make sure you check that out. Anyhow, please be careful next week. I do think that risks are elevated here in the near term, as I mentioned on Thursday to members. And now that we've seen the selling start and the VIX rise up above 20, it could escalate early next week. So again, be very, very careful. And I'll be back next week to give you the summary of next week's action. Have a great weekend, everybody. See you next week. Happy trading.